Hello investors, welcome to Proceemo, the value stock analyzer. Today is November 21st, 2022. Happy early Thanksgiving. Thursday might be about turkey and stuffing, but today I'm more interested in Big Macs and French fries because the Proceemo stock of the week is McDonald's. For the next couple of episodes, I want to focus on recession stocks. We may not officially be in a recession in the United States, but it's certainly starting to feel like it, and many folks are predicting it. Don't forget to like and subscribe. Your support will help us continue making content for you. What is a recession stock? I'm sure far more qualified investors have their own opinions on what makes a good recession stock, but I'm going to boil it down to a couple of key attributes. I'm also thinking a recession stock is something that I can put my money in during a recession that will either maintain, create income, or even have a little bit of growth. So those key attributes, they are, first, their business is an essential staple. Something like food, housing, energy, health services are essentials. People need those every day. Second, not aimed at the middle of the quality tier of their industry. More on that later. And third, experience weathering the storm in previous economic downturns. McDonald's actually checks all three of these boxes. McDonald's is in the food industry. Everybody needs food to survive, plain and simple. Not everyone needs high-calorie fast food, but we like it and continue to buy it anyway. McDonald's also doesn't cater as a medium entry food provider. It is fast food. Now, what do I mean by middle tier? I'm referring in the food industry to other offerings like Red Lobster, Applebee's, Chili's, and so on. Middle tier players often do not do well during a recession. In fact, many of them go bankrupt or out of business. However, the lower end, and inversely the higher end, tend to do pretty well. Third, have they been there and done it before? Has the company weathered similar or worse storms? Having that experience gives the leadership team way better odds at being able to do it again. And of course, there are no guarantees, not in this world. McDonald's has been through more economic downturns than most though, and have fared pretty well. As we've said before, past performance is not indicative of future returns. I'm a big believer in that. There are no crystal balls. All we have are educated guesses when it comes to investing. Unless you have inside information about a company, in which case you really shouldn't trade that stock. Everyone knows McDonald's. It's one of the most recognizable brands in the world. Founded in 1940 out of Chicago, Illinois, McDonald's went public in 1966 and now has over 40,000 restaurants worldwide. Loved by billions, from children to athletes to authors and even presidents, McDonald's has stood the test of time for over 80 years. There's a great book, Good to Great, by Jim Collins on how good companies become and stay great. The 30,000-foot view: consistency. It doesn't matter that it's packed with fatty and sugary calories. I know exactly what I'm getting when I go to a McDonald's. A quarter pounder on Monday is going to be identical to one on Friday, and it's going to be the same whether I'm in Boise, Idaho, or Jefferson City, Missouri. It's oily, it's not good for me, it might make me feel lousy later, but damn it, it is pretty tasty. Okay, enough of that, let's get into it. McDonald's is trading at $273.73 with a market capitalization of around $200 billion. Compare that to 12 months ago, they're up almost 12%. How many stocks in your portfolio are up at all, let alone double digits over the past 12 months? Probably not many. Coming back to the top, we have our segmentation. This is important. How much of their business is in the United States versus international? Looks like 38% is in the US, 52% international, and 9% of revenue is from other sources. It's good to know. International companies are not necessarily better situated to weather a storm during a US recession, but we can see McDonald's has a good balance of business. McDonald's does pay a dividend, and we will cover that later. Let's get into implied growth. Implied growth is a calculation that tells us how much growth is baked into the stock price based on its earnings today. Implied growth is not a crystal ball, it's merely a measure of the current stock price compared to previous earnings. McDonald's implied growth is 12.58%. Let's compare that against revenue and earnings growth today. Revenue is up 20% between 2021 and 2020. The next annual earnings report will come out at the end of December, but they look like they're going to come in a little lighter than last year, somewhere in the $22 billion range, which would be a decline of about 5 to 6% from 2021. 3-year average is 4.09%. 5 and 10-year average revenue growth is actually negative. minus 0.58%, and minus 1.18%. That is not exciting. Let's look at earnings. Earnings for a company like McDonald's is more important than revenue. McDonald's is going to have high revenue. It's a space that's completely saturated, so we're not going to expect massive gains in revenue for the most part. Earnings tells us how efficient they are with their operations. Revenue minus cost of sale. McDonald's had a massive increase in earnings in 2021, 59%. That's huge. The year before that was down 21%, and then before that, only 1.71%. So not exactly a linear earnings report over the past couple of years. Why are their earnings so large this year? Because 2020 was not a normal year. Their earnings were down due to the pandemic. Restaurants were closed, sales were down, etc. This is why their balance sheet is so messed up. So we need to look a little past that. If we subtract the 2020 to 2021 spike, we have a 5-year average around 12%, which is almost 1-to-1 with implied growth. Maybe the stock is priced just right after all. Over to our new key metrics, we have an enterprise value of $230 billion compared to our market cap of $200 billion. So by that indicator, we're a little bit on the low side. Let's check the scorecard. Implied growth over 5-year actual growth, which I do kind of want to ignore, is still close to 1. A 1 here means the stock is priced fairly, and we just mentioned with implied growth, it kind of adds up. Liabilities over assets is a very high 1.09. We say a ratio of 0.3 to 0.6 is healthy, and they're way above that. If we come over to our charts and look at the assets and liability trends, we can see the ratio was even higher last year because their liabilities were higher and their assets were lower. As of the last annual earnings, liabilities are coming back down and assets continue to rise, so this ratio is hopefully starting to trend in the right direction. Steady dividend is true. Let's look at those dividends real quick. $1.25 in August of 2020 compared to $1.52 in 2022. They not only maintained the dividend through the pandemic, they continued to increase it. That is great shareholder value, but this growth did come at a cost. The dividend ratio is 2.33. This ratio reflects the cash on hand with the current dividend payout, which signifies their ability to keep paying it long term. McDonald's is a little low. We'd like to see this closer to 4.0, which would mean 4x cash to dividend payouts. 2.33 is bordering on concern in my opinion, especially with the high inflation numbers we're seeing in the economy. Market cap to revenue multiplier is 8.62. There's no magic number here. I did a quick comparison to Yum Brands and Domino's. McDonald's is higher, almost 3x that of Domino's. To me, that just means that the market has more faith in McDonald's right now compared to those other brands. And also, the market may have more faith in their ability to weather a recessionary storm. 5 years of increasing revenue is false, no surprise there. 120% of assets greater than its market cap, also false. 3 years of revenue growth greater than 10 is true. This is largely driven by the massive delta due to the pandemic. If we subtract that year, this rightly becomes false, and we are still not surprised to see it. Increasing revenue growth for 3 years is false, really no chance on that one. And 5 years of assets greater than 150% of liabilities, also false. Finally, revenue per employee, $232,000. That's well above the average McDonald's salary and right in the middle compared to Yum and Domino's, so I think we're okay with that. Going to our charts real quick and looking at EBITDA, it's spiky. We know it'll be down in 2020, but even before that, lots of peaks and valleys. Where does this leave McDonald's for us then? Ba-da-ba-ba-ba. I'm selling it. I'm not crazy excited about it, but it's also not bad. I think some of the recession stock mentality is already baked into its current levels, which is going to limit its growth. What McDonald's does have to offer is its dividend, and let's face it, the brand. You would be crazy to bet against McDonald's. They're not going anywhere. In fact, they are planning on opening 1,400 new restaurants over the next 12 months. They will continue to grow slowly and pay a nice dividend along the way. If that's your cup of tea or your side of french fries, then buy a bunch of it. 8 shares of McDonald's will let you buy 1 value meal per quarter, so at least you have that. That's it for today. Please like and subscribe if you found this helpful. And if you really want to support the channel, please go to Proceemo.com and subscribe to our monthly service to see analysis like this for yourself for only $5 a month. Thank you to all our new members over the past week. And if you have a stock you'd like to see featured, please comment below. Thank you. Happy investing. Happy Thanksgiving. Go find some value.